How to invest in the recession. Hello everyone. Welcome back to our channel. Today, we're diving into a topic that's on many people's minds during uncertain times: how to invest in a recession. Recessions can be challenging, but they also present unique opportunities for savvy investors. In this video, we'll walk you through strategies to consider when navigating the investment landscape during economic downturns. So grab a notebook, because we're about to explore some valuable insights. The first question you may ask yourself is, what is a recession? The International Monetary Fund defines it as a sustained period when economic output falls and unemployment rises. A recession is usually defined by gross domestic product, known as GDP, falling for more than one period in a row. It is normally characterized by a cycle where a decline in GDP results in reduced consumer demand and spending driven by high interest rates and inflation, which further compresses GDP growth, and ultimately businesses make less money in profits. In order to stem the flow, businesses then look to cut back and scale down production, which results in higher levels of unemployment. This just exacerbates the issue, and the cycle continues. The UK economy in particular is forecasted to shrink this year, which presents worrying times ahead. At present, we are facing high interest rates, a very high cost of living, with a number of individuals and businesses struggling to stay afloat. Although recessions can be painful, they are also a great opportunity to build wealth. A number of the wealthiest individuals on this planet have made their fortunes during a recession. Have you ever heard of the saying that in a recession, the rich get richer and the poor get poorer? Well, let's get into how you can keep one step ahead and prepare for a recession. Tip 1. Cash is king. Recessions normally present the best buying opportunities for investors. Think about it. The vicious cycle of a recession depresses the financial markets, and this results in asset prices falling and being marketed at discount. But these markets always recover, and if you have the patience to ride it out, then you can make some significant financial gains through the correct investment choices. For context, going back to 1937, the average recessionary drop on the S&P 500 has tallied roughly 36%, which provides context how much market prices can fall during a recession. In order to benefit from this, you need cash reserves to purchase these discounted assets. Do anything you can to build your cash reserves, whether that is budgeting, saving, side hustles, or reducing debt. Cash is king in a recession. Tip 2. Do not panic sell. During a recession, there is a lot of volatility, and as we already covered, there is normally a downturn in the markets and its prices. Buying and holding onto those assets, even when the market is falling, takes a lot of guts and confidence in your choices. The market is designed to make you feel anxious and scared. It is designed to make you irrational and make knee-jerk decisions solely based off emotion and the short term. You see markets failing and you immediately fear the worst and want to cut the losses. It is only natural in uncertain times. But to really take advantage in a recession, you have to focus on the medium to long term. Markets recover, asset prices recover. What has gone up must come down, and what has gone down must come back up. It is a cycle and how markets work. Millionaires are normally not made overnight, but many months and years. It is important you focus on a sufficient time horizon for all of your investments. And before you invest, always do your research on the asset or company. Look at their annual accounts, review financial information, read the latest news, go on their website, look at their competitors, go on social media, and see what other people are saying about them. By doing your research, it will give you greater conviction in your investment decisions and give you peace of mind to avoid panic selling when the markets are falling and in the red. Tip 3. You cannot time the market. It is impossible for anyone to know where and when the bottom of the market is and the absolute best time to buy. And if anyone says they can tell you, they are probably telling a lie. So if you cannot time the market, what is the next best way to invest? Well, you can look at historical trends and identify areas of support and resistance, which can provide you with an indicator of a good level to invest at. Failing that, just be consistent with investments and drip feed through dollar cost averaging, such as setting up a regular debit for purchases each month. Instead of purchasing shares at a single price point, with dollar cost averaging, you buy in smaller amounts at regular intervals, which allows you to smooth your average buy-in price. To really succeed with your investment decisions, time in the market will always win, and therefore, dollar cost averaging is an approach adopted by many individuals. Tip 4. Take a long-term view for your investments and maximize compound interest. Everyone wants to get rich overnight. If it was that easy and quick, everyone would do it. Where most people fail is that they do not have the patience to see out their investment decisions. Imagine this: you invest a certain amount of money, and over time, not only does your initial investment earn interest, but the interest itself starts earning interest. This snowball effect is the essence of compound interest. The best part? It works quietly in the background, allowing your money to grow exponentially. The earlier you start harnessing the power of compound interest, the more impressive the results. Whether you're saving for retirement, a dream vacation, or other financial goals, compound interest can make a significant difference. Tip 5. Do your own research and hold a diversified portfolio. To really protect your investments, it is important to hold a diversified portfolio across assets and risk profiles. By having a diversified portfolio, you are reducing your exposure to the market, as losses in one risk asset may be offset by gains in another asset class, compared to, for instance, holding all your investments in one asset, which puts you at mercy of the market. You may ask yourself, what type of assets should I invest in? That decision depends on your risk profile and personal circumstances. But look for companies with strong balance sheets, companies that have a history of paying dividends. Look at recession-proof companies such as healthcare and utilities. Look at consumer staples and avoid cyclical sectors. Think about investing in indexes and ETFs rather than single companies. Ultimately, economic downturns do not last forever. If you have a sufficient investment horizon, you should be able to benefit from the market recovery. And there you have it, folks. Investing during a recession might seem intimidating, but remember, preparation and strategy are your best allies. By following these tips and staying focused on your long-term goals, you can potentially turn the challenges of a recession into an opportunity for financial growth. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel. Until next time, happy investing!